Good to have you with us this morning. So we mentioned, don't be surprised if you see a little bit more selling pressure. We're already seeing the U.S. futures in a mixed mode. And of late, we have talked about that challenge for equity investors. After a big run-up in tech stocks earlier this year, that group has certainly lost momentum. I want to get some more perspective from Christine Tan. She's portfolio manager at Sun Life's SLGI Asset Management. Good to see you.
Good morning, John.
How have you felt about, I know we were just talking, you like fall weather. I don't know if investors like this early fall stock market performance. What have you made of it?
Yeah, I think definitely I love the fall weather, but the market volatility to some extent shouldn't be unexpected because we've seen a very strong rally especially in the U.S., although in Canada it's been a bit more range-bound. But certainly investors are probably a bit more worried given what's happening in the bond market, I think, is what's more notable.
So is it a reflection of how the market had done this year that we're seeing this, or is it because there's really more to worry about with those headline stories we keep talking about? You know, one of them is interest rates staying higher for longer as the economy is showing some cracks.
Those are great points, and I think it's a combination. So you've priced in a lot of optimism. Remember, we were talking about the soft landing the last time and how investors started thinking about that, more so in the U.S. than in Canada. And now you're starting to worry a bit more about how much has been priced in. But it's definitely the higher for longer that's been priced in. When you look at what's happened to real yields in the U.S., it is quite spectacular how much it's increased just in the last few weeks.
Just remind our audience why that matters, what's happening with Treasury yields.
Well, if you think about treasuries as sort of your risk-free return, right, because you know that the government will be able to pay you back, whether it's through higher taxes or through just more quantitative easing. So if you can earn a certain yield in the market in a risk-free way, then valuations and riskier assets have to correct to provide you a better return. That's why it's important. So when bond yields go up, valuations on stocks will have to go down to some extent to account for that.
Is there also just the bond market is sending a message of worry too that would perhaps put a little bit of pressure on stocks?
Depends on how you define worry. So to some extent, what the market's pricing in is, the bond market is saying is, we believe what the central banks are saying about higher for longer. So in a way, the higher for longer reflects more inflation and maybe a more resilient economy. So it's not necessarily the bond market's worrying that much, because typically it's, if you're worrying about a recession, bond yields typically fall.
Well, what are you worrying about? I mean, are you looking at this and saying, I got to get out of stocks?
No, we're actually pretty, not complacent, but we're pretty calm about what we're seeing. We think to some extent the stock market is starting to reflect the worries that we had for several months now. Valuations have come back quite a bit. So if anything, we're sort of looking for opportunities to neutralize our underweight in equities.
Okay, well, what is that all about? Walk us through how you think about constructing a portfolio in the fall of 2023.
It's a great question. So we came into this year thinking about recession. So we were overweight bonds and we were underweight equities, kind of in that view that earnings would fall quite a bit and bond yields had room to come down if we go into recession. As the year progressed, especially in the U.S., data became more resilient and it's showing itself to be better than expected, which is reflecting itself in bond yields and also in the stock markets doing better. So what we've been doing is being a bit more tactical. So we're responding to the data. So when I said that we're taking opportunities to tactically neutralize our underweight in equities, this is more of a short-term move. We are still worried about a slowdown in 2024, but it looks like it's been pushed out a little bit. So that's how we're constructing the portfolio on the equity side. On the bond side, we've been pretty consistent. We prefer quality, we prefer governments over credit. We still don't think we're being compensated enough to take on credit risk.
We put up a board for our television audience on your view on U.S. stocks versus Canadian stocks. I guess when we're looking at it at that high-level view, Canada has a lot more exposure to banks and commodity names.
That's
the
right.
U.S. overall gives you more exposure to growth stocks.
That's right.
What's your general feeling right now?
So generally, we do have a slight preference for U.S. and the emphasis on slight. So we talked about the relative resilience of the U.S. economy. Part of it is just the way the rates market works. So they have 30-year mortgages. We have 5-year mortgages. A third of our mortgages are floating, so there's a lot more sensitivity to rates. And what you just said, our markets have more cyclicality, a lot more materials, a lot more energy, a lot more financials. So we do prefer the resilience of the earnings side on the U.S. Now, it's only a slight preference because the valuations reflect that. So Canadian equities are trading at about 2 turns of PE below its long-term average. The US is slightly above its long-term average.
You know, we're nearing the end of September here, and we came into the month. I tried to say it as much as I could, that it's a bit of a toss-up
Yes.
in terms of performance. There's a lot more easy-to-access historical data on the S&P performance, but I was looking at the last couple of decades of TSX returns in September. It's basically mixed. Usually it actually skews a little bit more negative than positive. So you're watching the headlines. Doesn't sound like you're extremely bearish on investing right now. Do you think there's a fair possibility that while there is this worry out there, that stocks could be a reasonable place to be over the next, call it 6 months?
Yes, and you do have to pick your spots, because if you think about what companies have been doing, the CEOs have been worried about a recession as well. They're reading all the same headlines we are. So they're preparing their businesses to the extent that they can. Balance sheets on the whole are relatively strong, but you do have to pick your spots. So you have to make sure that you're in the right companies that are much more resilient. So that's why we have a preference for quality on the equity side. Just making sure that these are businesses that can sort of earn its way through and survive a slowdown.
We're almost out of time, but quality or earn their way out, are you, like, what do you look for in a business? Not to pick on it, but it's a pretty cliched thing to say. So like when you're like, I want a quality investment right now, what are the components of that? What are the financial metrics to look for?
Great question. So right now we're no longer as much in the macro market, so we're not necessarily picking big sector tilts, but you're picking the strongest businesses in the sectors. So balance sheets, making sure there's not too much debt, nothing that's coming due in the near term, where you're going to have to refinance at a much higher rate. Making sure that the management team has experience managing through a slowdown, so they know what they can do. And ideally, if they have some pricing power. So if they're able to sort of manage their business, they have some sort of competitive moat. Ideally, customers will still stay with them through a slowdown. Those are how we quantify quality companies.
Sounds like the